Now, here is what you've been waiting for. Let's dig into example 7. I will do this using IFRS, and then your homework will be to do this using US GAAP. Okay, this is a very simple manufactured example. So you have a big company in the US that buys some land in a foreign country, okay, and then it lends or rents that land out to a farmer. Okay, that land has been purchased using a loan. Okay, so what is the expense for the big company in the US? The expense is an interest expense. Okay, what is the revenue? It is the rent that it gets from the farmer. Okay, so when this US company started the foreign subsidiary, it started this in January 2008. So I'll just give you all the numbers. Okay, so let me start with the top left. In January 2008, the price index was 100, and then you are given that during 2008 there was immense inflation. So the price level went up from 100 to 200. So what's the inflation? 100%. The average price level during the year was 125. Note that we will use that average for the income statement. Okay. You are also given this information on the right. What's on the right? Yeah, and just to check your basics from economics, what's the base currency, the dollar or the foreign currency? Yeah, you have one unit of the foreign currency. So which currency is strengthening and what's weakening? Yeah, dollar strengthening, foreign currency weakening. The quick way of looking at it is if the exchange rate goes down, that means the base currency is weakening. Okay, so here the base currency weakens quite a bit over the year. So that's the macroeconomic situation. In terms of the income statement for the year, in foreign currency, the revenue was 1,000, the interest expense was 250, and the net income was 750, again in foreign currency. Okay, again from a foreign currency perspective, the balance sheet on 1st January looked like this. The company had cash 1,000, land 900,000, so that's your total assets, and the loan or the notes payable is 500,000, the capital stock or the equity is 500,000. Okay, 1 year later, what happens? The 750 net income increases, the dollar strengthening, foreign currency weakening. The quick way of looking at it is if the exchange rate goes down, that means the base currency is weakening. Okay, so here the base currency weakens quite a bit over the year. So that's the macroeconomic situation. In terms of the income statement for the year, in foreign currency, the revenue was 1,000, the interest expense was 250, and the net income was 750, again in foreign currency. Okay, again from a foreign currency perspective, the balance sheet on 1st January looked like this. The company had cash 1,000, land 900,000, so that's your total assets, and the loan or the notes payable is 500,000, the capital stock or the equity is 500,000. Okay, 1 year later, what happens? The 750 net income increases the cash, and that's your all of it is retained, no dividends paid out. Okay, so this is your foreign currency balance sheet at the end of the year. Now, what's the question that we need to grapple with here? How do you translate the income statement and the balance sheet into US dollars? Okay, now what did we just learn? What's the big picture? How do you translate? You restate for inflation in the foreign country, and then what do? And then you use the current rate. So that is the IFRS method. So you start with, let's start with the balance sheet here. So you take all these numbers which are your balance sheet numbers. So in foreign currency, the cash is 1750. Okay, the land is 9,000. So what do you do with the land? So you restate it. So land now is 18,000. right? Why is the cash 1750? No, cash is cash, right? So it's a monetary asset. So your cash is still 1750. So your total assets are now 19750 in foreign currency. What do you do with your notes payable? That is still 5000. Capital stock, again, you go historical. So capital stock becomes 10,000. Retained earnings, so retained earnings 750. So this becomes 4750. So your total amount here is 19750. Okay, but this is important. What's happening over here? So it's basically a plug. So you know where the 19750 comes from? Okay. So you know where the 5000 comes from? You know where the 10,000 comes from?
Capital would also be adjusted this way.
Yeah, this is the accounting rule that your capital, the amount that you contributed initially, that also gets.
In the earlier examples, we did not adjust.
In the earlier example, we just had one asset. Okay, that was really simplistic. Now this is also simplistic.
No, I'm talking about the temporal and the.
Yeah, that we'll have to. Actually, we can look at those examples again. But here the method is that you are, yeah, there we didn't do any restatement. Here we have to restate based on the current price levels. So this then just becomes the 4750 is just a plug to make sure that the total comes up to 19750. Yeah, so notes payable is monetary, so 5000 worth of notes payable, that is not restated. Okay, so this is your inflation adjusted numbers for the balance sheet, and then everything gets translated at the current exchange rate, which is the rate of 0.5 at the end of the year. Okay, so this is what your translated balance sheet looks like. Okay, what about the income statement? Income statement revenue is 1000. This is slightly misaligned, but remember with revenue, the revenue is being generated throughout the year. So there you use the average. So you restate based on 200 over the average price level, and similarly the expenses are also restated based on the average price level. So these are the restated numbers for revenue and interest expense. So that is your subtotal or your income. But remember, what else did I say? In a very high inflation environment, you also need to put in your purchasing power gains and losses. Those are equal to 3550. Now, are you going to ask the obvious question, which is? No, this is how can you plug? You don't know what the net income is. So actually, I'll show you on the next. So partly you can do it through plugging. But you also, from an exam perspective, need to know how to calculate the purchasing power gains and losses. That we'll do over here. The top segment of this slide is what you've already seen. In the bottom segment, you need to understand how to calculate the gains, losses. What is the gain from holding the notes payable? So you had a payable of 5000 before inflation. Okay, now the way this works is, to calculate the gain from notes payable, you look at the change in price level divided by the original price level. So that will give you the gain from holding notes payable. So the way you can look at it very simplistically is as follows. I owe you 5000 rupees today. Okay. Now, 1 year later, let's say that the buying power of that 5000 rupees has become half. Okay. Or in other words, things that were worth 5000 are now worth 10,000. So, but I still need to give you 5000. So the gain in terms of buying power is 5000. Okay. So purchasing power gain is 5000. What about the cash? Now, cash needs to be broken into two components. We need to see how much cash we had at the start of the year, which was 1000, and then how much cash did we make during the course of the year, which is 750. Okay, again, in terms of the 1000 that I had at the start of the year, what happens to the buying power? How much buying power did I lose? I lost half. So I lost, the way you can think of it is the buying power loss is 1,000. All right. Because the stuff that at the beginning of the year I had 1,000, at the end of the year, stuff that I could buy for 1,000 now costs 2,000. So effectively my loss in terms of buying power is 1,000. And the way you calculate the loss for the remaining 750, since it's 750 that you've received over the course of the year, there you simply do 200 minus the average price level divided by average price level. Don't get too hung up over this, just take this as a given. So there again, there will obviously be a loss. So the total net purchasing power gain is 3550. Why did we have an overall gain? Because our liability, our monetary liability was more. Okay, so what is the moral of the story here? That if you are operating in a highly inflationary environment, then you make sure that you issue fixed rate bonds, and those should be much higher than the cash. You should keep very low cash and issue fixed rate bonds. Yeah, so when you are dealing with this gain or loss, you are only dealing with monetary assets and liabilities. Actually, the point over here, so I'll quickly summarize. We've done 2-3 things. All we are doing on this slide is calculating what is the purchasing power gain and loss. The purchasing power gain and loss is based on your cash that you hold and your monetary liabilities. What else we did on the previous slide was, here we did everything. Here we, when you are translating your balance sheet, you need to translate every item on the balance sheet, and every item is translated by taking, say, the monetary assets. The monetary assets don't need to be restated, because if you have 1750 in cash, that's 1750. You don't, what do you restate that as? But if you had land originally for 9,000, that needs to be restated based on inflation. So all we are doing is restating as appropriate. Just use your logic, okay? And then you translate using the current rate. Okay, so we are saying, so the question is for income statement, why 200 over 125? So we are saying that the average price level during the year was 125. That number came from here. Okay, so the $1,000 that was generated over the course, or this is 1,000 not dollars, 1,000 foreign currency units, came over the course of the year. So rather than just doing 200 over 100, which is what you would have done if it was all at the beginning, you take an average number. Okay, your job now is, how would we do this under US GAAP? Under US GAAP, we would simply use the temporal method. I don't think it is that significant from an exam perspective. Already, we are in a domain that is 2-3 levels deeper than the most likely question that you will get. At most, there might be one question in a case study on hyperinflation. Why? Because while it happens, it's not that common. The most likely question that you will get is regular subsidiary.